Let's get to those top picks. Jacobs Solutions, which of course is the big engineering company. Let's have a look at the chart there. 3 years? Is 3 years the good one? Or we just got a 1 year for that one? Okay.
Yeah.
1 year's okay?
1 year's good, 3 years is good as well. We can kind of see it's come back to this level there that it had trouble breaking out to back last year and then early this year, and then away we go, and then a little bit of a downside there on some earnings. Now, this is a position that we had taken an initial. We don't always go up to our full allocation. We kind of start, and maybe it's a little scaredy cat way I started doing. Well, let's just take a little bit of a position. So we've got a great opportunity here to pick up another one. This is stock, I think, long-term is fantastic. They're a provider, as you touched on, engineering, design, construction, maintenance. They do some cyber engineering as well, and security solutions. The earnings, as I touched on, were not that good recently, so we're kind of giving a really good chance here. They've got some fantastic tailwinds, the whole space, because of some of the things government are doing. Particular tailwinds for them is infrastructure updating. Everyone's got to update their infrastructure, space exploration, intelligence, analytics, energy transition, supply chains investment, and general 5G technology. They're also all touched on that. And then their focus on water and transportation makes them really ideal in capturing a lot of this infrastructure money that's here for another 10 years or 15 years. So good spot to pick these guys up on. I think if you like to head 2 or 3 years, you'll be quite happy.
Tourmaline Oil, a favorite, excuse me, among energy investors.
Is that right? This stock is absolute quality. They used to be a little company that kind of their management isn't little, but they're probably not a household name. A lot of people would probably say some other Suncor or CNQ, but Tourmaline, yeah, fantastic. Tourmaline's this is that value play here, I believe. You could have some blowing around by the energy, by the energy sector, what happens with OPEC and the price of crude. But if you're looking long term, these guys are fantastic. What they do, they're the largest natural gas producer in Canada, the 5th largest on the continent here. They've got assets all across the Alberta Basin, the Peace River, the Montney Formation. As I said, mostly natural gas. The recent earnings were fantastic on all accounts, including increasing their production. Their capital budget's been, which is a good sign of health. We're going to keep spending this money on these projects. That is 7.5%, and they've made a top priority to keep returning cash to shareholders. So that's always a good sign of the health of the company. I think, like Jacobs, you go ahead 3 or 4 years, you'll be really happy with this stock.
Okay. And finally, as advertised, Apollo Global Management, the giant player in private equity.
Yes. Now, these guys are a little bit, they're not quite as easy to understand as Berkshire. These guys, as you touched on, Andy, they focus on really illiquid investments and private equity in credit, equity, real assets, capital solutions, financial services, and retirement solutions. With expected continued volatility, I've mentioned one reason because of the interest rate potential going forward, just gyrations out there. Grabbing an asset manager with a really good asset, with a good team, we're standing on their shoulders to see value in places we just can't see that. And certainly in private equity, as a public manager, I guess you could say, assets, mostly a manager of public assets, we can't see all over the world, let alone in private equity where you want to get some with a really good, as I said, a team, a good track record of that. And why do you not want to get an asset manager to help you manage your own assets a bit here and there? So we like these guys too. There's a bunch of other ones. Brookfield is fantastic, KKR, and then Berkshire, sort of the preeminent one.
Are they vulnerable to rising interest rates, the private equity crowd? Because they use debt a lot. Yes,
yeah, they are vulnerable to that. They've got a good track record, but they are things that are illiquid cause problems for private equity at times when other managers of more liquid assets can navigate distressed markets a lot better. So you do have to have a bit of patience with the gyrating markets and these guys picking up value. But yeah, you're right. There's some liquidity issues, and at times of the market, it can be a bit more distressing, or distressed markets can be a bit more hard to pick up at certain times, navigate.
Always great hearing from you, Hap. Thank you very much.
Thanks for having me.
First idea is Pfizer. Of course, they just had a setback on their own diet drug.
Yeah, so Pfizer is a bit of a contrarian stock pick for me, Andy, at this point. We talked about this earlier in this show with respect to, a lot of the pharma companies really piling in on the obesity drug space. And Pfizer, to your point, has had some disappointment in getting into that. My view on this is that's probably not necessarily a bad thing. The acquisition of Seagen, which Pfizer's in the middle of completing, really gets it back to a more diversified space with respect to oncology, which is ultimately where I think you're going to see the strongest growth. I'm not saying that obesity drugs are not going to be used, but I just don't see the same sustainable growth space. So we're looking at Pfizer right now at these valuations, around $29, which are extremely attractive, and think that we've got good long-term pickup in the stock over the next 3 to 5 years.
Next idea is Microsoft. We touched on AI already, and just remind us, Andrew, is AI one of the reasons you're drawn to Microsoft?
Well, definitely. I think, and we've seen this clearly in the last couple of weeks with respect to the drama in the AI space. Microsoft definitely is well positioned. And, we talked about this earlier about the ability of a company to integrate AI into its end user experiences, and whether that's Salesforce. But we're also looking at that with respect to Microsoft. So the Copilot rollout with respect to Microsoft Office, we now have 7 million subscribers. And we tend to think of this kind of like Adobe with respect to Firefly, another AI integrated end user product. Subscription services are extremely valuable to the bottom line for companies like Microsoft. So yes, you look at it as a tech play on AI, but we look at that subscription base, and if we see continued growth in that, we think that's going to be definitely positive for not only revenue growth, but also earnings growth going forward.
And finally, Tourmaline Oil. For a lot of investors, this is their favorite nat gas play.
Absolutely. So bringing it back home to Canada in a space that I think is going to see decent growth. I mean, this company, if we're looking at companies that may offer decent share buybacks in 2024, this would definitely be one of them. Great third quarter earnings that we just saw recently, well positioned in the gas space, and we think we're going to see good long-term growth from this company going forward in nat gas.
And generally, let's put up a 5-year chart for U.S. natural gas. I mean, obviously, it's a volatile commodity. A good cold winter would help, though.
Cold winter would help. But I think also looking at the transition space, Andy, so the transition from fossil to electric, as we or most of us know, is not going to be a light switch. It's not going to be an on-off. We're going to have to see some reliance on nat gas to get us to that point if we're going to shift away from coal. And I think ultimately that sometimes is a demand factor that's overlooked by the investment community. So we're pretty bullish on nat gas prices going forward, and bullish on companies that can take advantage of that, and that would be the case here.
Andrew, thank you very much indeed. It's always great hearing from you. First idea, and we did refer to it already, the BMO Long Federal Bond Index ETF, ZFL. Is that U.S. federal or Canadian?
These are Canadian federal, so ideal for Canadian investors. And I'll tell you why we chose to highlight it. It's because we found in our research and working with clients over the past several years that many of the investment advisors that we work with at National Bank, their clients are almost over-allocated to cash within their fixed income portfolio. That was the right decision up until recently because the bond market was crushed in 2022. But now, if you need to mix something alongside with cash and take on a little bit of what we call duration exposure, you could do that by buying a broad aggregate bond ETF like ZAG. We talked about that earlier. But if you want a little bit of a position to add alongside your cash and kind of barbell in a little bit of rate risk in a very kind of capital efficient way, ZFL or ETFs like it. There's one from TD, TCLB is an example, very similar. PGL from Invesco holds some Pravis. There's one from iShares, XFLB, very new launch. It's a bit smaller. It's a bit cheaper in terms of MER. So it's a growing category. It's one that's interesting to our bond traders because, if rates really do kind of peak around here, it would be an appropriate entry point for some significant rate exposure.
And if we did go into a brutal depression,
That's right.
Heaven forbid, but that would tend to push up bond prices, presumably.
This would be one of the few asset classes in the portfolio that would zig when the market zags, right? That would give you a bit of that anti-correlation benefit. That's what bonds really are for in a portfolio. They just aren't able to deliver that when rates are extremely low, which they were up until 2 years ago.
Your next research highlight, Invesco International Developed Dynamic Multi-Factor ETF.
Yeah.
Give us the précis on what this one does.
Yeah, I know. It's a bit of a mouthful, but it's an interesting new product. You know, the multi-factor space in Canada was one that kind of blossomed with a number of new products a few years ago, but they all kind of had a bit more, too much of a tilt to the value factor that kind of drove their underperformance through the kind of big bull recovery after the COVID crash. This one is different. It's different. It's new, it's small, so we would consider a bit more of a speculative play. We're choosing to highlight it because our strategist said we are favoring international over emerging markets and with a tilt towards the quality factor. What are quality companies? Those with stable ROE, you know, low debt to equity, and so on. Quality metrics which are separate from value metrics like price to earning or price to book. So this ETF it means to capture all of the factors, the academically recognized factors like value and momentum, but it switches between them based off of signals. Right now, we're in a bit of a kind of, perhaps a kind of contraction mode, perhaps heading into maybe a mild recession, maybe a sharp recession, we don't know. But it is biased to quality right now. So for your international exposure, we would think it would be an interesting product to look at. Just trade with it carefully because it is very small and new.
And then your final idea is a clean energy ETF, HCLN. Of course, clean energy stocks have suffered.
That's right. So that's why that's why we're highlighting it today. It's because we published a note earlier in the month, in fact, last month, on tax loss trades. So if you happen to own any clean energy stocks that are particularly beaten up, we're heading into year end. You have until the kind of last trade settlement deadline, I believe it's December 27th this year, to effect some tax loss trades. Consult with your tax advisor, but if you're in a lost position, selling a stock and cycling into an appropriate ETF that's correlated for at least 30 days, so the sale is recognized by Revenue Canada. That is a way to kind of right-size your portfolio, make sure that you still get exposure to the very interesting investment themes like clean energy that you want, but if there is, for instance, a very sudden and rapid recovery over the period in which you've sold your clean energy stock, you'll at least get a participation in that market recovery should it happen. It's something we've already saw happen with the banks. We saw a lot of tax loss inflows into the bank ETFs a number of weeks ago, right around the bottom. Anybody who sold bank stocks and then bought the ETFs instead of the bank stocks would have participated in the recovery. Anybody who was just sitting in cash on the sidelines would have had no exposure. So this ETF is a bit of a highlight because we talked about it in addition to many other sectors like materials. Also, if you have some material stocks, you know, you can look at an ETF like XMA, that's the iShares Materials ETF. If you have utility stocks, a ZUT from BMO, utilities were also beaten up. But clean energy in particular was a focus for a lot of our clients who are holding some of these names, wanted to kind of recognize and crystallize a tax asset on their balance sheet heading into year end. And this ETF is equal weight. It's a good way to do it.
What did you mean crystallize a tax asset?
So if you sell a stock in a loss position, you get a tax write-off credit because it can be applied back 3 years, applied in the current year against other capital gains, or carried forward indefinitely against other capital gains you might get. So that's what we mean by a tax asset. Again, we're not tax experts. Consult your tax advisor, right? There are right ways to do it. You can kind of like, trip over a tripwire if you do it a little bit wrong. Like if you buy, for instance, an ETF that tracks exactly the same index as another ETF that you've sold, that would be considered identical property. That would not be a true disposition in the eyes of Revenue Canada. So again, a bit of a complex topic, a little bit of a tax wonky highlight, but that's what we wanted to talk about here.
Yeah, I think there was a slight problem with the chart we just showed. The vertical scale had a percentage, but I think it should have been dollar figures there. Yeah. Sure. Daniel, thank you very much. We always learn so much, and we could talk all day to you. Thank you very much.
Thanks, Andy. It was a blast.
Welcome back. Time now for Top Picks with Mike Philbrick. Mike just took a viewer question on a Bitcoin ETF. One top pick today, the Ether Fund. Another sounds like a cryptocurrency ETF. Ticker symbol QETH.UN on the TSX. So these are units. Is this in fact an ETF, Mike?
No, it's an innovative investment structure vehicle that trades an awful lot like an ETF, and there is a .U version as well if folks want to own it in a USD construct. And it's designed to provide exposure to, as you said, Ethereum, which is one of the leading cryptocurrencies and blockchain platforms. Now, Ethereum is more of a technology than it is a digital currency. It's a decentralized platform that enables sort of smart contracts to be built and operated. So that's the use case for it. And you might think about adding something like this to your portfolio in a small amount to provide some diversification to traditional portfolios. Cryptocurrencies are in their frontier phase in the development of an asset class. So there's growth potential here. And in Canada, 3iQ has done a wonderful job of blazing the trail and providing access to this asset class in a safe way. So these are held in cold storage where you don't have to worry about losing any keys. You can access them through your brokerage accounts and those types of things. So you have this ease of access, which is really unprecedented globally. And the opportunity here is interesting. So what they've done with the Ether product is they've added yield staking, which is a way in which you post your Ether, make the Ethereum network safer, and at the same time you receive a yield for that. So they're taking a portion of the portfolio, staking that, and achieving about a 1% to 2% yield on the portfolio. And lastly, they've waived the management fee until March 31st of 2024. And Ether is lagging. Bitcoin has been the leader here. So Ethereum has been lagging. And this might be an opportunity for investors to now consider Ethereum alongside any Bitcoin holdings they have. And as I said, 3iQ has done a very good job at blazing the trail and making robust structures so individuals in Canada can own these vehicles in their regular brokerage accounts.
Okay, we are going. We're running a little bit low on time. So if you can give us about 60 seconds on each of the next two. The first one is the Horizons Global Uranium Index ETF, ticker symbol HURA on the TSX.
Gotcha. Okay, so uranium. Again, this ETF gives people exposure to uranium stocks and the uranium yellow cake itself. The growth potential here is pretty substantial. If we're going to get to a zero carbon world, there's no way you can really do that without nuclear energy, which is, of course, underpinned by uranium. In fact, uranium is an extremely small portion of the cost of electricity when you produce nuclear energy. So uranium can go up 2, 3, 4, 5, 6-fold and really not have any negative implications for the production of electricity in the areas that we're having that happen. So we have a nuclear renaissance if we're going to go with zero carbon environment. And then lastly
is the Cambria Emerging Shareholder Yield ETF, ticker symbol EYLD.
Yeah, and this one trades in the US. Now, we did have a chance to cover the difference between shareholder yield and dividend yield. So the nice thing here is we're taking that into consideration in the emerging market construct. So now you have emerging markets looking both at their dividend yield, their stock buybacks, and their debt payments. This is a much more robust way to fundamentally get quality stocks in that area. And again, I'd say that most portfolios in Canada are underexposed emerging markets. This is a great prudent approach and a way to get access to these with a high quality factor. And this is going to diversify portfolios, I think, in a lovely way, and do it in a way that seeks to have that quality aspect of the companies in the portfolio.
Mike, thanks a great deal on behalf of our viewers for your time today. Great to have you here. We look forward to having you back on Market Call.
Brookfield Infrastructure Partners is your first idea.
So it's been held back and struggling on concerns about liquidity, capital, recycling, growth. But we expect their growth to accelerate in Q4 with contributions from Triton, Compass, and Heartland starting to kick in. Q3 was in line. See this as an environment for them to capitalize on low-priced assets. If interest rates can pivot from here or not go higher, that could be a bit of a tailwind. Really love this 5.6% distribution that's growing with a nice 50% payout ratio. We do model 11% AFFO growth, adjusted funds from operation, trading at a reasonable 10 times, 9 times 2025. So if you're looking for the rally to broaden, and people are wondering if the rallies are, it's going to broaden out, I think this name should be a beneficiary. And I think that this name's also being held down maybe as one of these tax loss names that people haven't made money on over the last year. So maybe they're clearing it out for that. So all things being equal, I think it can maybe have a nice pop just on that into January.
Your next idea is Rogers Communications. It competes with our parent company, BCE.
Yeah. So, amongst the telecom, first of all, they're doing very well in wireless. We think that they're going to start to see the benefits of the Shaw deal in terms of scale. This name, if you look at BCE trades at 17 times, TELUS trades at 22 times. This trades at 12.4 times or 10 times 2025 with a better growth rate than both of them, 16% growth rate. So, I think the synergies from Shaw are tracking ahead of plan. Wireless results in Q3 were very impressive with net subscribers up 18% year over year. I think that their combined entity gives them more capital to do some more interesting things longer term, like in coaxial cable, 10G. So I think that this is a name that's done nothing for a while, and I really think that it will. And you get paid a decent dividend to wait as well.
Yeah, dividend is about 3.25%, but of course that's only about half the yield on TELUS or BCE.
Right.
Yeah.
So that's one of the reasons why people are drawn to BCE and TELUS, and both of them aren't at bad levels here. And TELUS, trades at a higher value, but it's got a good growth rate. Like all three of them are good. But Rogers, I think, is the bell of the ball.
And then, of course, they own the Toronto Blue Jays, and there's talk that the Blue Jays might buy this baseball superstar, Shohei Ohtani.
Right.
We could be talking about a $500 million contract.
Well, that might be worth it for a guy that, is a pitcher and a DH hitter, right? So
he hits home runs and he pitches.
And he pitches, yeah. So I'm just kidding about whether it's worth it or not. I don't, that part I don't know. But wow, that'd be great for Toronto if we can get a guy like that.
I mean, what an athlete to be able to perform at that level, both hitting and pitching.
Yeah, that's stunning. That is stunning.
Your final idea here, Meta.
Yeah, so I am looking around for value stocks that maybe are going to pop into January that are held down, and Meta is not one of them really, because it's it's had this incredible run, but it is growth at a reasonable price, and it's trading at similar levels growth price as Intact or Definity, which both showed up really well in the P&C space, and I was thinking about maybe them, but Meta's got better growth than them longer term, trading at 16 times, 2025 growing at 17%. This name is critical to the way we communicate, and there's tons of ways for them to monetize into the future. Their earnings per share last quarter was up 164% year over year. Their revenues were up 23%. They're beating on every metric, DAUs, MAUs, monthly user activity, ARPU, average revenue per user. So, I think that if you want to get a name in the Magnificent Seven that's not trading, not getting the respect that they should, I think that this is the name.
Yeah, it's fascinating because what do they have? 2 billion customers? I can't even remember.
No, more than that. I think they have more than that. But it's a matter of, do they have a third of the planet, or do they,
right.
And when are they going to get half of the planet? Yeah, as customers.
Thank you very much indeed. And if we don't talk to you before the end of the year, Greg, have a wonderful holiday.
You too, Andy. Thank you very much.